Welcome to yet another episode of All Things Money. And today we are going to talk about the flavor of the week, that is the Trump tariffs. So, Fatima, what's happening there?
We all know what's happening. The Trump team woke up, came up with a very interesting formula and slapped tariffs on everybody.
Is that even a formula?
I don't know. There's a lot of Greek there, a lot of alphabets, but when you summarize that, it's just the deficit that Pakistan has against the US. They figured out the percentage, divided by 2 because Trump was feeling kind, and slapped that.
So,
it's not actual tariffs that Pakistan has put on US imports.
Exactly. I think that is the thing there. It's being called tariff, but it's not really tariff. So, what's really happening there is that they basically looked at every country's deficit and then they looked at the exports that the US does to that country and said, okay, you know what, this is it. This is the kind of deficit we have. Let's just divide it by 2 and just have a plain simple thing around, which I think it's not a bad idea.
How is it not a bad idea? We are poor countries. We cannot buy as much from the US as US can buy from us.
Why not? I mean, US sells a lot of stuff. Maybe stop buying from, let's say, other countries like China and buy from the US. Because that is the calculation that the Trump administration is doing. The formula essentially means they want to reduce their trade deficit. So let's say if I'm Pakistan, what should be my strategy? My strategy can one be A, can you please reduce the percentage or whatever arbitrarily, or if you can just start buying more from the US at better terms through better negotiation, maybe that automatically comes down. So it just works for both parties this way. Again, we need to understand what the US is selling and whether we can buy them from them or not. For example, LNG, US is starting exporting LNG. Why can't we buy LNG from the US?
Or shale.
A lot of these things, US is a net energy exporter. So multiple actually iterations open up. And this is a question that every country would be asking. And eventually, I don't know, it just may lead to a reduction in US trade deficit because instead of, let's say, buying from China, you can actually buy from the US and increase that denominator. And when the denominator increases, your overall percentage reduces.
And where does distance factor in, given China is a neighbor and US is far away?
So that is the calculus you need to do, right? What are your exports more valuable to you or are your imports more valuable to you? So if that reduces, if net welfare increases by reducing that percentage, then you might as well just buy a little bit more expensive imports to ensure that your market share stays there. Or let's say, for example, I think one thing that we can look at is in relative terms, the tariff here, Pakistan is somewhere around 29%, 26%, and Vietnam is at 46%. Bangladesh is like 35%, Laos, Cambodia around 40%. So this is a great opportunity for Pakistan.
This might be a great opportunity for Pakistan. India has a slight advantage which might be neutralized, but see, what could happen is heavyweights like India could reduce the tariffs, actual tariffs that they have from the US, increase their imports from the US, and then negotiate a better tariff rate.
So again, it's all relative.
It's all relative.
It's still an advantage. I mean, if you want to look at it as an advantage.
Advantage.
I mean, everything is an advantage.
Potential advantage, because you also have to factor the inflationary effect. We supply to the lower middle income groups in the US. If there is inflation across the board and they cannot afford to purchase our exports, our apparels, our socks, then it doesn't matter what the tariff rate is, they just cannot afford to purchase it.
No, I think that's not really relevant here because the cost curve keeps going down for textile. So it's like the race to the bottom at this point. It's not like as you said, we're not really selling very expensive stuff there. Right now, suddenly what you have is you've got like a, let's say, 20% advantage relative to Vietnam, or a 15% advantage relative to Cambodia, maybe a 10% advantage relative to Bangladesh. So it is possible to actually encroach on their market share and get more out of it. Again, the obvious is India as well. I mean, they can do it too, but it's not like we want to capture all of the market. So just a little bit here and there is still better for us. Point being, no one is really taking our market share, but we can get more of others' market share.
Nobody is taking our market share right now. But if China, India, or Indonesia, Bangladesh, heavyweight players who are exporting more, importing more, if they negotiate better tariffs, which is part of the Trump plan, right?
Obviously, everyone needs to do that. Yeah. It's not like we will have to just sit like lame ducks and do nothing.
The big players, Interloop, Gulam, whoever is part of the supply chain of Adidas and Zara, Inditex and whatever, they might be a bit cushioned because they have those long relationships. But the unbranded players, the smaller players, for them, whoever they are supplying to, their purchases are just going to shift to whichever country can even give a 2 cent.
And that is why
advantage.
that will continue to happen, and that's why, again, this is an advantage. It's not a bad thing.
Potential
It's
advantage.
potentially a good thing for Pakistan.
Could be a good thing.
And let's see how that pans out.
Whether this tariff cut is significant or just window dressing.
I think a lot has happened over the last 1 year, and a lot of, I would say, room has been recovered through more efficiency than anything else. I always say that power in Pakistan, it's actually a good problem rather than a bad problem, because
You are the only one who's saying that.
because again, you can never be a rich and prosperous country with higher income levels without access to energy. So you need energy if you want to grow. So by saying that we have surplus energy, that's a fool's errand, because okay, you have surplus energy, great, use it to actually increase your incomes. No one's ever said, oh, you know what am I supposed to do now? I have so much power available. Well, you use it, you produce something, and then you increase your income levels. That's literally how the world has grown over the last, I would say, 300 years. So when people say, oh, we have surplus power, what do we do now? We're going to die. No, you're not going to die. You're actually going to use that surplus power to produce more. The problem was you could not produce more at very high price levels, and that is a problem, and that is a problem that has been solved through multiple interventions. One thing I think
Has the problem been solved?
it is being
Interventions
solved
or not?
as of this point. Again, we need to understand it's like a 100-ton gorilla, and just maneuvering around it, it cannot solve it in a snap or overnight.
So let's get into specific. 7 rupees approximately is the tariff
Yeah,
cut.
yeah.
Will that help industries?
I would say 7 rupees a bit too much at this point. Shouldn't have been 7 rupees.
Really?
Yeah. So let's look at the breakdown here. I think the ballpark estimate that's coming out is essentially okay. Let's step back a bit. 30% of your power tariff, well, 1/3 of your power tariff roughly, was various taxes. So those have been rationalized to a certain extent, and a reduction in tax on electricity is eventually been passed on as higher taxes for petrol consumption, which makes absolute sense, because about all of your almost petrol or diesel consumption is imported, while electricity, roughly 70% of your electricity is actually indigenous and locally generated. So in terms of pure electron or molecule basis, you're actually supporting indigenous consumption more rather than external imported consumption. So this is a nice economic rationale here to penalize or tax imported consumption more and encourage domestic consumption or domestic production more.
If this was so nicely, so logical, why was the IMF so against it? Even now, the Prime Minister said that this is a favor to us.
So IMF was against it again because they don't want different tax rates for different things. That is a thing. If you look at GST, this is what's happening in the electricity tariff. The general sales tax has been reducing. They want a stable, relatively simple GST regime everywhere. That is what the real issue was. It was more of a nomenclature than on economic merits. Nomenclature is decided by humans, decided by people like you, me, and everyone else, and that can be fixed. Economic rationale has been clear since day one, that you encourage more electrification and discourage more fossil fuel consumption.
So you think that the 7 rupee rate cut is too intense, but the LSM has been in negative for quite some time, or the improvements have been very marginal. Would this be able to incentivize LSM?
So I would say LSM, the way it's calculated, it's a bit flawed anyway, but that's a topic for another time. What's really happening is we need to understand how price elasticity works. You cannot just say, okay, so if you look at a long enough timeline, a 1% cut in, let's say, power prices generally leads to a 0.3% growth in consumption. So, and there is a very strong correlation that exists between electricity consumption and GDP growth. Now, in a steady state, how much industrial consumption can actually grow? Let's say it can grow up to 5%, max 5% or 6%. So to get that to that 5% number, even a 15% cut would have been fine, but we're looking at somewhere around 25 to 30%. So that's an extra delta that you gave to the industry. So 15% cut, 0.3%, if you look at the multiplier effect, this actually gives you around 4.5% of growth. But we need to understand industrial growth is just not purely dependent on electricity consumption on its own. So when industrial growth happens, there is a demand for more inputs. There is a demand for imported inputs, which means there is a constraint on that side, because you cannot import more because again, imports is still being rationed. We don't like to talk about it, and that is fine. And you need more dollars for that. So once you have industrial growth, you will also need more dollars to import. And that is where the calculus gets screwed up. And that's why your industrial growth cannot just like go up to like, let's say if it's 30%, industrial growth increases by what, like 10%, 12%. It simply cannot happen. So max ceiling you can hit is maybe around like 5%. That's about it. And
5% of economic growth or 5% of LSM growth?
5% of LSM growth eventually leads to, let's say, 5% industrial growth, which plugs into your overall GDP figure as well. And this segment is largely import driven because intermediate goods or primary good imports are there. So that is a constraint, and because of that, you cannot hit a very high number. So I think 30% is an overshoot. And another thing that's happening is there was a good, I would say, incremental consumption package that was in play in the last 3 months, December, January, February, and that also led to a reduction in electricity prices on an average basis. So I think incentivizing more efficient players, that is a way forward rather than just flatlining everything else. For example, if you are an industry, if you're an entity, you're operating at 70% capacity utilization, and now through an incremental consumption thing, you have an incentive to actually increase your capacity utilization from 70% to 100%. So your average cost actually goes down. And this is, I think, more relevant because you're just being more efficient about it and producing more by being more efficient. So this package will most likely be followed by another incremental consumption package, hopefully that extends for at least 2 to 3 years so that industries and units can plan their investments and capacity expansions accordingly. Again, coming back to where we started from, that capacity is not a problem. It's a good problem to have. If you didn't have capacity, if you had like rolling blackouts every day, that would have been a much bigger problem. Right now, this is a more policy-oriented problem which can be solved through a pricing mechanism. And that's a much, much easier problem to fix than actually setting up large-scale infrastructure.
So I'm not the energy person, clearly you are. There's something that I would like to understand. Initially, there was this entire conversation that we can bring down the petrol prices, and as you said, they rightly gave that cut in the electricity. Now, since some part of our electricity generation is based on imported fuels, with Trump's tariffs, especially as Trump is putting tariffs on Canada, Mexico, a whole bunch of countries, if it causes a Ukraine-Russia-like situation in which oil prices go up, wouldn't that decrease the room that we have for our electricity tariff cut, and in which case the 3-year plan that you talked about would not be very viable?
So what's actually happening right now is globally we're potentially going towards a recession, oil prices are declining. Certainly we are in a better position right now because we're not integrated into the global value chains per se. And that's a very bad thing, but in times of crisis that somehow becomes a good thing. So, and imported fuel over the last many years, reliance on indigenous fuels has increased substantially. So I would say around 70 to 75% of our electricity mix right now is purely indigenous and local. Furnace oil consumption is less than 1% of total electricity generation right now. The only fuels we import is essentially RLNG and some imported coal. So our reliance on imported fuel purely for electrification has significantly gone down, and over the years that this may actually increase to 90%.
When do you see that 90%
by 2030, our local,
over the next 5 years.
Over the next 5 years, 90% of electricity will be generated through local resources.
Which would be?
Which would be a lot of coal and solar, if you want to call that as well. So I think that's a great thing. That's something that people often miss out on, and that is what energy security really looks like.
Coal, it has become such a contentious word now. So there's so many layers to this. So one is Thar coal and Thar coal's quality of coal. Then there's the logistic challenges to get it to the wherever it needs to be generated. Then there is the global climate change conversation. So when you say that till 2030, 90% would be local and that would be through Thar coal, don't you see a lot of challenges along the way?
I mean, the world is actually moving back to coal because they realize you need base load. The sun can only provide you electricity for like 6 or 7 hours a day. What do you do?
So the entire climate change conversation just falls to the ground.
I mean, you can actually look around and look at all the proponents of climate change. Suddenly they have slowly and steadily started removing any references to climate change. The US is restarting.
Yeah, but that's Trump. Drill, baby, drill.
No, so that's it. So why should we, a country with
No, I agree. I think we should go for charcoal because we missed out on the industrial revolution. They are the ones who polluted the
we
world.
need more industry. So you get someone coming here giving you a lecture, oh, you know what, you shouldn't use more coal, where the same country has been using coal for the last 200 years and still uses more coal than you could ever
Absolutely
could.
agree the logic of it, but the world doesn't always see it that way. We always do not get funding because for charcoal because of that.
So and that is fine. I think this is what the problem is. A lot of these things can be done indigenously. So if Germany continues to use lignite, if the US is restarting its coal plants, or what exactly is stopping us from having an industrial revolution on the basis of low cost energy, other than let's say a few seminars and some publications?
So there will be no hurdles to fundings from any multilateral donor if you continue down this path.
Do we really need multilateral funding for
Do
that?
we not need multilateral
We don't.
funding?
We can finance that locally. That can be financed through internal capital. So
Internal capital, like we go to the banks,
you go to the
local
bank.
commercial
Again,
banks.
our investment to GDP ratio is fairly low. Savings to GDP ratio is low, and that is a systemic problem. If you increase that, sufficient capital is available.
Would local banks have that kind of capital required?
So that
I mean, they are busy, financing the budget
you
deficit.
don't need a lot of that capital anymore. And that is where the whole story of increasing your savings rate comes. Obviously, you need to do that for everything else as well. You cannot just keep relying on multilateral and foreign.
Absolutely, we
capital
still need
to do
IMF
that.
write-offs.
So we need to do that. If you need any kind of industrial revolution, you need access to low-cost energy. When we started this conversation, it was about you've never had a rich country that increased its income levels without increasing its energy consumption, energy intensity. So if you want to be a rich country, you need to consume more energy. There is literally no way around it. And those who say you should not be consuming more energy, well, they don't want to be you to increase your income levels.
What are the main top energy consumption industries in Pakistan?
We don't have any, sadly.
What about crypto mining? Is that something we can consider?
That's not an industry.
That is not an industry yet.
That's a nice fact to have, but does that produce anything?
That is the question with the whole new crypto council coming up, with the government saying we are going to use electricity for work.
It's 5 years too late.
But if we can use our excess energy that we have to mine bitcoins, why not?
I mean, if you could use it, people are already using them.
There was this whole rumor about using excess power in Faisalabad or somewhere. They would use the energy subsidies for textiles and then they would mine crypto with it. There's a whole conspiracy about it.
So if anyone can do it, they're already doing that. Again,
so this is not something that is viable down the road.
This is not something that's viable down the road, because again, what are you actually producing?
Bitcoin that we can sell online, even if it has no intrinsic value of its own.
It's nice magic money.
Exactly, nice magic money. Sell Bitcoin, turn it to USD, turn it into dollars, and boost the reserve. Trump is doing that, for the love of God.
Again, they're not doing it from a state endorsed level.
They are talking about having Bitcoin, the Bitcoin that they already own as part of their reserves.
Yeah, again, it's nice magic money. It's great. El Salvador did this experiment. And
it was not very successful.
Now they are shutting it down.
Yep.
They're shutting it down.
It has not been successful in any country.
It has not been successful. Yeah. So, yeah, I mean, it doesn't work.
It has not been successful pre-Trump. If Trump decides that Bitcoin is part of our strategic reserve and the world starts to move away from the US dollar, then maybe Bitcoin will, I mean, I'm not a proponent of cryptocurrency. I'm just saying, perhaps it is something that will be at a bigger play. And if we do have excess energy and if we are regularizing crypto, then maybe we are talking about potential and possibilities. Maybe this is one possibility that can be considered.
Sure, you can consider it, but
because if not crypto, then cement sector would consume electricity?
Rather, let's say, build steel. Out of cheaper energy available.
If we build steel, we need the construction sector. The construction sector is not the sturdiest right now.
One of the greatest examples of economic growth in the last century has been of South Korea. In South Korea, the biggest steel industry is called KOSPI. And if you go to KOSPI's unit, it just says in very large letters or terms that steel builds nations. So you need steel to build a nation, whether it's a road, whether it's a factory, whether it's any product.
But steel needs demand to build factory, road, building.
Again, that's the thing.
Again,
so
that,
do that, right? If you want, you can either have an industrial revolution or you can have a magic money revolution.
Why can't we have both if you have so much excess capacity for electricity?
You don't have enough. There's a finite resource.
We are not going to go increase our steel production by 500% in the next
We don't need to.
5
We don't
years.
need to. See, we just need, again, we lack the basic components for any kind of industrial activity. You need a petrochemicals unit. You need steel. You need aluminum. These are the basic building blocks that we need. So it's just that, it's a household which doesn't have enough food to eat, if this it doesn't really have shelter, doesn't have security, but you go and sell them a very nice high-speed internet connection. You don't need that internet connection right now. Right now, you just need enough capital to give people jobs, to skill them, to ensure that the next generation can eventually catch up on the knowledge economy.
Where would that capital come from? We have excess capacity for electricity, but we do not have the other ingredients required for LSM, for large scale manufacturing, for industry. So where would that capital come? We don't even have that money. The banks are like.
So that is a thing. I think this is what I was talking to you about earlier, that maybe I can just shift what I was supposed to write. Our savings to GDP ratio has been terrible for the last so many years. I don't even know how much. The timeline doesn't even go that far back. It's around 12 to 13%. And why is that? Because a lot of our savings is in informal channels. It's in cash. It's in gold, it's in foreign currency.
It used to be real estate, but now it's a bit tricky.
It still is real estate because a lot of that capital essentially is stuck in real estate. So what you really need is to move that capital away from those into more productive enterprise. Every single country that in the world that has grown has done the investment to GDP ratios for middle income countries or lower middle income countries that continue to grow has been in the range of 25 to 30%. We are stuck in the 12% range. So if you want to do that, if you want any kind of industrial growth, if you want any kind of production-oriented growth, this needs to increase from 12% to 30%. Now, that is something that needs to be done at a macro level. And obviously, that is a core basic ingredient for whatever we're talking about. Without increasing your savings rate, you cannot have higher investments. Without having higher investments, you cannot move from a consumption-oriented growth model to investment-oriented model. As I said earlier, you can have as many power curves. You can reduce the power price to zero. Hypothetically, let's just say we reduce power price to zero. What's going to happen? You can have a massive industrial boom, but it will be constrained by your ability to import. So you need to have that structural change in the economy where you move towards more export-oriented, production-oriented growth rather than anything else. So what happens? Let's say you reduce electricity rate to zero. Everyone says, reduce interest rates to 5% or 4% or whatever. What happens then? You start importing more and more consumption-oriented goods. You're not producing anything. So what's happening is, whatever real estate money you have, you start importing imported cars, and suddenly that becomes a hedge against dollar. So you don't want that. If you want to grow, if you want some kind of production-oriented activity, you need to move that capital from the informal economy to the formal economy.
And how do we do that? I mean, there's a whole Sharia compliance interest rate.
Again,
then there's inflation eroding. I don't have a savings account because inflation will erode it away.
Sharia compliance, every other country in the world is Sharia compliant right now because everyone wants that Sharia money. Isn't Saudi Arabia Sharia compliant?
Yeah, and we are moving towards that.
Indonesia,
but we're talking about,
Malaysia.
if we are talking about increasing the savings, so one thing we are moving towards Sharia compliance. So say that improves. The other thing is, do people have that, like if there is a family business, I mean, you and I, we don't have enough to actually increase investment in the country, but there's a family business. Are they even investing in Pakistan, the big businesses?
So that is the thing, and that is what needs to change.
And how do you change that? That is that conversation.
So I'll give you an example. We are here in literally the heart of the country in terms of pure economics and commercial activity. You just walk down to any bank branch and say, I want to open an account. They will not open an account for you. Meanwhile, you call someone up and ask them, I want some gold. They will deliver gold to you in the next 30 minutes. So what's happening here? It's just much easier to move your capital in the informal economy and actually try to move capital to the formal economy. When you try to open a bank account, people hate this when I say this, in a court of law, you are innocent until proven guilty. For when you open a bank account, you are guilty till you prove that you're innocent. And the onus of proving that is on you. So with this kind of structure in play, no wonder people don't trust any formal financial institution and they just stick with informal economy. This needs to change and this will eventually lead to how capital is actually mobilized in the economy. Because if this doesn't change, you will never have enough capital in the economy that can support any kind of industrial growth.
Absolutely, there has to be more streamlining. We should be able to open an account online. But even then, we're talking about billions of rupees if we want to increase investment in Pakistan. That is not just opening a bank account. That is convincing local investors to invest in Pakistan.
That happens.
And then when they invest, they should be able to import because intermediate goods.
That is the whole cycle that kicks in, right? We're trying to convince foreign investors to come. Why will a foreign investor come when a domestic investor is not ready? So again, you have to create that environment, and that environment isn't really created through seminars or whatever workshops. So it just happens by having a core structural change, by actually getting more capital in the formal economy rather than just.
And that's a conversation that involves taxes, corruption, streamlining of agencies. I don't know how many agencies a single license is required for construction, for example. I remember talking to somebody in real estate, like, you try getting anything done without your journalist license and then I'll ask you. Because obviously there's a lot of money under the table and all this. So it's not just streamlining investment through opening bank accounts.
Again, capital.
And the capital has flown a lot out since the pandemic.
And it can come back as well. I always say capital seeks higher rate of return, higher rate of risk-adjusted return. You reduce the risk, you increase the return, it's going to come back.
Obviously.
We did the IPP renegotiations, and so capital is going to flow out. I mean, that capital is still flowing around here.
So you don't think that, so that's something a lot of guests on the show have said, IPP, renegotiation, surrender guarantee, we will lose investors. That's not something you agree with?
No, actually not. The same capital is just looking around for better opportunities locally. Better, more government guaranteed opportunities, ironically.
Better, more government guaranteed. I mean, government guarantee. I think we should need to get out of that government guarantee framework.
That is the point. That is why you need a more competitive structure. And coming back to, we just basically deviated away from tariffs, coming back to the whole power conversation. This is where a competitive market for electricity actually makes more and more sense. You need to really move forward to a competitive market for electricity for any of this to happen. So that's what.
But that's something we've been talking about for some time now. Competitive market for electricity.
Somehow we're very close to it now. The execution needs to be there now.
Execution needs to be there, but isn't that usually the hurdle? Execution and implementation.
It's happening. I can tell you that it is happening. But how soon can it happen? Maybe another few weeks. Maybe another month.
Before the budget.
Maybe a bit before the budget as well. So this can happen.
That would be huge. That would be bigger than the power tariff cut.
And
no?
Yeah, that will be bigger. But when it comes, suddenly it will be like, okay, the comparative markets are now what? Nothing changed in July. But it's a whole transition period.
Just for the next 5 years, the next 10 years.
For 3 years, for 2 years, 3 years, not even 5 years. So basically what happens is you suddenly open up a market for buyers and sellers. Right now what's happening is the government is the sole buyer of electricity. And obviously the government buys at a rate which is cost plus. And cost plus basically means, okay, you know what, this is the cost that is used for making this, let's say, cup of coffee. There's this fixed cost of this cup. Someone got this cup from somewhere, there's a fixed cost involved. I'm going to charge Ammar. This cup may be used 100 times. I'm going to divide that cost by 100 times and add to it. And then there's a cost of coffee and then the cost of creamer in it, so on and so forth. But if no one is drinking coffee, on a per day basis, the cost of this cup is still being charged. This is how the market is currently structured. In a competitive market, it will depend on what the buyer and seller want. So if I want coffee and there is no coffee available, I'm willing to pay a higher price for it. But if there's too much coffee available, there's more supply, I'm going to pay a lower price for it. Now, and that is where the buyer and supply can work over what the demand will be like, what the supply will be like, and the government will be just basically out of the equation. And essentially the demand and supply of electrons is eventually going to determine the price rather than...
So overall this would bring down the electricity tariffs down, or theoretically they should?
They should and they will.
Right now the power cuts has made the stock market really happy. Another new rally has happened today. So this is something that we can look forward to down the road.
1,000 points, 1,500 points. I think if you look at it in pure percentage, it's for like 1%.
Sounds good to say though. Another new high.
It's cute, but doesn't work. So, and that's the thing. The stock market has been on an inflation-adjusted basis. We're at what, like 2020, 21 levels? So
in dollar terms, you're still way
there is
over.
a lot of room to cover before you get to that point where you can have actual real growth is being captured by the equity market. And once you move that needle on the capital allocation part, where instead of going the capital moving into real estate or moving into gold, it actually starts moving into equity markets and you've got more listings in place, then you see that cycle of investment really going.
Let's really hope that virtuous cycle starts soon.
Yeah, and that is, again, you need to have the structural tools or the pillars in place before any of that can happen. Again, if I want to invest in the market, it's very simple. Like if I want to invest in the stock market right now, I will have to fill a 20-page form, give a compliance, tell them I'm the most honest person on the history of this planet, so on and so forth. Eventually, just maybe, I may be allowed to do that. If I want to buy a plot, I don't know who have to do any of that.
We need to have another episode on stock market and stock market alone.
So yeah, I think this is it. The core issue here is availability of capital, and power tariffs reduction will provide that stimulus, and it is an important stimulus. But to really take it to the next step, power is one of the many ingredients. If you look at all companies around, if you even look at the companies listed on the exchange, power costs make up maybe like 10 to 15% of the total cost. That's it. So you're solving for the 15%, but there's something 80% remaining as well that you need to solve for, and that needs to be solved for as well, because before you can.
And that's the 80%. That is the lion's share that needs to be solved for.
And again, all of these things are interconnected. Having the right tools in place, having the right, I would say, even the direction in place, solves a lot of these problems. So with the marginal thing that I talked about, it's going to hopefully give a direction. Hey, this is how the prices will look like, 1 year, 2 year, 3 year level. So you can plan accordingly. The real problem occurs when there is no direction, when you have no visibility beyond a month or so.
Pakistan has a very low savings rate. Our savings to GDP ratio is abysmal, and that is something that the IMF has pointed out, multilateral donors has pointed out, research has pointed out. So will lower electricity rates create room for increased savings, or is this too small a part of the equation?
And this is a wrap.